What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. All right, that was lots of fun. Welcome to this Chance Encounter, and today I'm joined with Denise O'Reilly. How you doing today, Denise?
Hey, I'm doing great. How are you, Dan?
I'm fantastic, especially because I don't know if you're aware of this or not, Denise, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a Chance Encounter where I interview commercial real estate players. That means deal sponsors, investors, buyers, sellers, all that kind of stuff. And you may ask yourself, why are you going to do that? And the answer is, if you've ever heard of an off-market private deal that you're not allowed to publicly discuss, sometimes it's called a 506B deal, then you should know that you need documentation of your prior substantive relationship, or else the SEC might get ants in its pants and shut down your business, and that's bad. But the benefit to you for watching these episodes is that you'll not only learn how to improve your ability to effectively communicate on the subject of a commercial real estate deal, but you'll also get to know how my guest fits into them. But before we get too deep into real estate, Denise, do you want to say a thing or two about yourself?
Sure. My name is Denise O'Reilly, and I'm with Flow Equity Partners. It's a real estate investing firm that I run with my husband, Michael. And we invest in multifamily in Texas and the Sunbelt region. And we also invest in senior assisted living. So
All right.
Sorry.
Continue.
We also have a fund, and we're excited about launching that as well.
Beautiful, beautiful. I love it. And that brings us straight to our first segment. Let me just add the presentation right here. And the first thing it says is, but wait, check your 8. Now, Denise, I don't know if you can do this or not, how good you are with technology, but maybe you can see through the camera and down into the user's device, but there might be this great big hideous subscribe button, and maybe they should just do something about it, especially if they have young kids around. They might judge, and that'd be terrible, right? All right, it's a stupid joke, but whatever. Let's talk about motivations. I have now interviewed hundreds of different players in this space, different people involved in real estate, and everybody has their own unique why for getting into this industry and continuing to stay in it. But I found they fit pretty neatly into these 5 categories. Now, the reason why real estate people would want to know another person's motivations is because at the end of the day, these deals have plenty of risks involved. They take months to close. They take years to go full cycle. So it's really important to know what's going to stop somebody from throwing in the towel. And the first motivation of which is preservation of purchasing power. What on earth is that? Well, some people, they don't have to have a job, or if they do have a job, they don't really need to do, they basically make more than they spend. And when you are in this advantageous situation, the way you make ends meet is from the proceeds of ownership. You have a portfolio of assets that pay you all the time just because you're the owner. And if you're in that situation, you might ask yourself, well, why would you bother making another acquisition? Because things sound pretty fine to me. Well, there are a couple circumstances that stand out. The first one is if inflation rears its ugly head, then that's going to be time for another acquisition, because it's going to eat away from the purchasing power of your cash flow. But the other one is when you can buy at a steep discount. Now, of course, everybody should try to buy their real estate at the steepest discount they possibly can. However, people who are in this situation where they've already got a nest egg, they're preserving their purchasing power, they're not going to have to pull the trigger unless there's something like an asset crash or divorce, other forms of distress. Now, I'm not that far in my real estate career. What I'm up to right now is trading time directly for wealth. And that is because I got a background in technology. I pursued the high salary, high wage earner industries. I specifically went into the CRM space and built all sorts of online funnels and online businesses, making sure that all of their transactions and mass marketing work seamlessly. But when I started working back in 2014 for a guy who'd been flipping houses, about 10 houses a month for years and years before he ever hired me, I started to realize that you're giving so much away to tax. It's really, it really isn't an effective way to build your wealth. So I pivoted and figured out how I can be involved in real estate and get rewarded in the form of deployed capital, aka wealth or equity. So that's my motivation. And I get that youngsters, I might as well, be speaking another language because that's just a little too abstract. What makes more sense to youngsters is they want to hustle like crazy right now so that they can fast track their retirement. But the more ubiquitous motivation that this one's describing is that people want to take control of their schedule. They don't want to have somebody else telling them where they need to be all day, every day during the week. And maybe they want to work fewer months per year or fewer weeks per month or something like that. And this is a really neat avenue to do that. The only problem with having this as a motivation is that a lot of people think that it's everybody's motivation, and I assure you it's not. There are some people who are driven by ambition. They want to buy their entire hometown. They want that generational wealth. They want to make sure that their great-grandchildren never hold a day job, and that's why they're going to hustle into their 90s, which is fantastic, even though I know it's vilified in some circles. But the fact is, these properties don't actually take care of themselves, and somebody who's got a lot of ambition and motivation has to be on the GP team to make sure things actually get done. So I think it's a little bit unfair. But the last group, they're also going to hustle into their 90s, but not so much because of their own family or their own generational wealth, but they have picked a sector of society, or maybe it's the environment, or maybe it's animals. Who knows what it is, but the important thing is there's a huge financial aspect to making a big impact in this world, and that's why some people are making their commercial real estate acquisitions. So Denise, from those 5 different motivations, what combination would you say describes you best?
That's a tough one. They all kind of resonate with me to a degree, but if I had to pick a couple, the ones that stood out to me were number 2, trading time for wealth, and also number 5, this right here, helping people who need it.
I love it. I love it. So let's get on to the next question then. It's tolerance for risk assessment. And I deliberately put it after the motivation part because we need to emphasize the fact that real estate is about the most mature industry out there. So it's going to have different risks involved because it's a business. Every business has risks. Now, if you've ever been involved in a 506B deal, then whoever the securities attorney involved was, they should have insisted that everybody fills out this super invasive financial questionnaire. It has all sorts of questions that aren't comfortable to answer, like what's your net worth and things like that. But other than that type of question, me personally, when I got down to the question about tolerance for risk, I felt that it lacked utility. The issue I ran into was it didn't matter which of the 4 multiple choice answers you chose. I don't think I could actually use it. So I made my own, and it's a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Denise, it can be inside real estate. It can be outside real estate. What's too risky for you to invest in?
I think investing in antiques is too risky. If you're outside.
Interesting. Yeah. No. I really like that one just because, especially in my time in Asia, I found that people don't have interest in antiques. They'd rather have something that they can get rid of when they're sick of and get something new. Is that part of that, or where, like, I'm just a little bit curious as to what made that one come up.
I just was looking at what the wealthy, studying what they invest in, and there's all kinds of interesting things. Of course, there's real estate and stocks, bonds, private equity, private debt, that kind of thing. And there's also art and antiques.
Mm-hmm.
And I kind of loved all of it. But then when I got to antiques, it kind of gave me pause. Like, I'm not sure about that. I mean, I'm not an antique expert. I don't know a lot about them, but it's not something that I would have in my portfolio.
Yeah, I love it. I love it. That's a fantastic answer. It brings me to the next slide, though, which is the favorite deal metrics. In full disclosure, I avoided including this slide in the original interviews just because I knew there were a lot of people who throw around words like capital raiser or co-GP, and really what they are at the end of the day is they're the front of house. They're the social media person to get interest in the deal sponsors' deals. And the issue with the fact that I thought I'd be interviewing a lot of people like that, and the good news is that it hasn't been that way. It's that they're not really going to have a background in underwriting. They're not going to spend tons and tons of time in the spreadsheets to see if there are any weird assumptions that just aren't in line with reality. So I felt it's kind of too much of a fastball to be throwing this one at them. But even if you are strictly on that investor relations side of the business, you're still going to have a few different deal metrics that you rely on to tell one deal from another. And so I want to make sure that you in the audience, if you reach out to Denise, then you're speaking her language. So I have a list of 14 different metrics so people can pick a top 3 or something like that. And for anybody in the audience who's only listening and not watching, I'll read them out. The first one is cash on cash. Second one is IRR, which is internal rate of return. Then there's cost per door, which is especially for residential. But net operating income, or NOI, is the next one. Then there's the going in cap rate, which is all over America. Companies have figured out what the going rate is as far as a cap rate goes for properties like that in that area. So it's really talking about the discount you're getting. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy rate, which is the inverse of the vacancy. So it's the same thing, just inverse. Then there's the average income where the property is located, the amortization period of the loan, the difference between the market versus the in-place rents, the population growth where the property is located. So you get a little bit of extra demand baked in there. The sponsorship record, which is how many deals have already gone full cycle and how many deals are on the go right now. Then there's the waterfall split or exit strategy, which really has to do with what happens to your investment after your capital has been returned. Then I have DSCR, which is debt service coverage ratio. Usually it's an indicator of how leveraged the deal is, but it comes down to how much of the revenue from rents and whatnot is going straight out the door immediately just to pay for the loan. So Denise, I know that this isn't an exhaustive list, so if there's something that you rely on that's not on here, you can go ahead and say that, but you want to give like a top 3 or something like that?
Sure. With multifamily, we focus mainly on value add multifamily. So some things that are really important that jump out are the NOI, the current occupancy, market in place rents, because you want to know how much you can raise those rents, what the market is, and if there's upside potential there. Let's see. Population growth is also super important. You know, we live in California, but we invest in Texas and the Sun Belt because that's where it makes sense. There's a lot of economic drivers, a lot of net in migration, a lot of Californians going to Texas. And that's super important for the future of that building and, you know, the ability for it to sustain. So that's super important. I said NOI and occupancy. You know, we do value add, but we like stabilized value add. Like, we're not going to invest in a distressed, like a building that has like 40% occupancy, because that's a really heavy lift. We want to make sure that they're kind of in the 80-90% range. And then they, you know, once we analyze the deal, we want to make sure that there's other levers that we can pull and a lot of other income opportunities that we can do, add amenities, add laundry, like washer and dryers in the units, add a tech package, give them reserved parking. We have to make sure that there's other income opportunities. So that's really important. And we have to know that we could exercise our business plan to increase the NOI, in essence, increasing the value of the property.
I absolutely love that. I don't know why I didn't switch back to the proper screen, but whatever. But I was still just eating up that answer like a delicious subscribe sandwich. It's a very subtle reminder there, but it tells me it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And the main reason why I include it, it really is the linchpin in understanding and more effectively communicating on the subject of commercial real estate deals, because these are the 6 core roles that you just can't do without if you're going to have a successful business. And if while I'm going through the 6 different roles, you're thinking to yourself, I really need to get me one of those cubes. Well, the good news is it's absolutely free. You go to dandoesdeals.com. There's this great big button. You just click on it. It goes straight to the PDF, and you can print it out and practice. And yes, you heard me right. I committed the cardinal sin of marketing, which is you should never give away your freebie without asking for an email address or some sort of contact information. But I do it because I really think that your future in this industry is going to depend on your ability to effectively communicate. So let's get started talking about the repositioners, who are the most visible people in commercial real estate because they're acquisitions people. They're looking at a whole whack of different properties. They're doing a whole bunch of different paperwork. The paperwork they're doing is underwriting the deal is one part, which means doing the math. They need to figure out not only is the property making the amount of money that the seller / broker is claiming it is, because but they also have to figure out how can they find more upside. The most peculiar part of being a repositioner is every repositioner has to have a vast network of financiers. So they spend a lot of time in financier relations and investor relations. The reason for that is because if you can secure a more advantageous loan, then it goes straight to the profitability of the building. So the financiers are people who only deal with the owners, the paperwork, and the money. They do not deal with residents or anything like that. So that's who financiers are, and why repositioners have to know a whole bunch of them. But the next part that a repositioner is going to do is they're going to get the operations team involved and figure out how to cut expenses, how to stop those Benjamins from going down the toilet. Now, of course, there's a lot more to operations than just the collections of rent and mowing lawns and unclogging toilets and all that kind of stuff. If you know about me, I'm from the internet. So you might ask, is like, how can this guy possibly add value in a GP team? And the answers are there's the digital aspects of running the business, like the actual web assets, the websites and whatnot. But the other one that's even bigger, especially if you're talking bigger properties like I've focused on in the past, there's a high likelihood that you're going to be outsourcing your operations to a third party. You're going to be doing asset management while other people are doing property management. But the Achilles heel in that is that vacancy is the enemy. And if they cannot fill the units, then somebody on the GP team needs some serious marketing chops so you can get that unit filled, because vacancy truly is the deal killer. So that's where I can jump in on a GP team. But there's only so much you can do with operations to optimize how it's running. So the next place the repositioner looks is the contractor team to do a value add and upgrade the property. Now, the entire idea being that the next residents will be more than happy to pay more in rent than the previous ones because it's nicer. But if only things were that simple. You can waste all sorts of money on contractors and construction CapEx. You can go ahead and gold plate the toilets, but I don't think you're going to get a decent return on investment. So that's why that's not a really, really great idea. And if you're like me and from the internet, you're really going to need a local. You're going to need boots on the ground, somebody who can be there in an hour or two, because it's not going to be me. I'd be stuck at an airport in an hour or two. So that's just plain not going to happen. The locals need to keep an eye on the contractors and the local operators, the third-party operations team, if there is one, because they got to make sure there's no cutting corners, dragging their heels, all that kind of fun stuff. But to explain the sixth and final side of the cube, I got to do a hypothetical. Let's say you're thinking of becoming a repositioner. Maybe you already own a few rentals and you're thinking, hey, I know how to buy a rental. I just get my deposit and I borrow the rest. So I bet if my friends and I, because I'm a physician or an engineer or an attorney or something like that, I bet you we could pool about 100K each, and then we could take over that 350 unit apartment complex down the road there. So full of confidence, you get it under contract, you turn around the financiers and say, hey, I got this property that I want to buy. It's 350 units. It's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you want to lend us, do you? Well, the financier is going to give you a rude awakening because they're going to ask you, who's the sponsor? Who's the KP? What's that all about? See, you're not going to be eligible for a commercial loan unless somebody in the fold already owns a similar asset. So what that means is if you want to buy a 350 unit apartment complex and you want to get a commercial loan to do it, they're going to say, okay, which one of you already is doing this, so we know you're not going to take our depositors' money, pick up the asset, and then run it into the ground and make it impossible to recover our principal. So that is why they're going to ask for a sponsor and KP. And if you're in a mentorship program or you have a guru or something like that, that's the part that they're going to gloss over more often than not. But the sponsor has to be in place. You also need a certain amount of liquidity to show that you can actually run the business. And then among the ownership team, you need a balance sheet of at least the amount of the loan. But if you have all that, you've got yourself a commercial real estate deal. So Denise, as far as those different roles in real estate, which ones will you take care of? I believe you work with your husband as well. So I don't know if you want to tag him into the mix, but where do you guys fit in?
So we've definitely been a part of that repositioning team, acquiring the assets, doing the asset management, investor relations. That's been a really strong part of what we've done so far. We have launched a fund now, so I believe that would put us going down the road of the financier and contributing capital to the deal. At the same time, we've been lead GPs and KPs, so we kind of have run the gamut on what you have described there. I haven't swung any hammers and fixed any toilets, so I'm not a contractor, but the other things I've had my hand in a little bit.
Okay, I love it. So let's talk about buy boxes then. And when real estate people are asking each other, hey, what you're looking for, what's your buy box, that sort of thing, we're really asking about three main parts. First one's geography. Where is it? Which state? Which county? Possibly even which neighborhood. We're talking about your ideal property here, so it's going to matter. Second one's going to be size. Now, in residential, especially multifamily, the way you define size is by the number of units, the apartment units. And the reason why it's relevant is because the type of team that takes over 10 and 15 unit apartment complexes, they're going to be fundamentally different from the ones that take over 150 unit apartment complexes. So that's going to matter. Other forms of commercial real estate go off of square footage or acreage or other types of units like pads or storage units, things like that. But the reason why size matters is the same regardless. But the third one is usually called class. I personally prefer to use the word desirability just because it's more than one thing, specifically the condition and the area. If you're talking about condition, it's how old is the property? How beat up is the property? What about luxuries and amenities? Is it a really nice place, or is it basically just a place to hang your hat for the night, as they used to say? That's the condition. Whereas the area, because it's residential, that means that the school districts are going to be very important as far as the overall desirability of the building. But every type of real estate will, to some degree, depend on the crime rate where the property is located. But the biggest one, everybody says location, 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 when they actually mean traffic, traffic, traffic. If a gazillion people go by that property every single day, it's going to be a lot more valuable than a place where that doesn't really happen. but both the area and the condition are ranked the same way as in grade school, which is A+ is at the top, and then A, and then A-, and then B+, and so on. So Denise, as far as you and your crew goes, what's your buy box?
We love to focus on the B-class value add workforce housing space. We feel like it's a great position to be in because in case of an economic downturn, you know, tenants in A buildings, you know, to save some money, they can easily slide down to the Bs. And when things are good, the tenants who are in the C-class buildings, you know, maybe they want a nicer place to live so they can go on up to the Bs. So it's nicely insulated. So I would say B class, and in a perfect world, in an A neighborhood, because that means you have tons of upside potential. And, you know, like you said, it's location, location, location. You can have an amazing building in a terrible neighborhood and it's not going to do very well. You can have like a beat up building that you can really make shine and look amazing, and in an A neighborhood, you're really going to do well. So that's kind of where we like to stay in that B class in an A, but a B neighborhood would work as well. Not mad at that either.
And yeah, great. Did you say the states that you're focusing?
Yeah, we focus more on the Sunbelt region. We invest heavily in Texas, the DFW area. We've invested in Arizona. We're looking at the Carolinas. So we really like that Sunbelt region.
Sweet, sweet. Okay, then let's talk about people. It's definitely my favorite part of real estate. Maybe it's because I came from tech and there's so many people who are antisocial in tech. But the fact is, because there are so many roles in a commercial deal, people in this industry tend to be really eager to make referrals, introductions, and stuff like that, even if they're not going to be on the team. And I chalk it up to the fact that because it's multifaceted, nobody's going to be all 6 roles of the cube for any meaningful amount of time. People tend to focus on the parts that they like or are great at. And then they find teams where that's what they need. Speaking of which, me personally, even though everybody in this industry is ultimately in the business of deploying capital, I'm no different as far as that regards goes, but in that regard I meant, but because of my tech background and the marketing and the social media bits and pieces, the sponsors and KPs, I always am typically more eager to speak to them because they've got a business already created, whereas someone who's a local or a repositioner, they might be just starting. They need people who can put in 80 to 120 hours a week, and that's simply not how I'm contributing my best. So those are the people who I'm most eager to reach out to, even now that I'm getting more and more into the lending side. But Denise, I imagine you probably work with accredited investors primarily and not 506B deals. But if you do have any 506B deals, don't go mentioning them and saying that you're looking for investors in the same breath, because the SEC hates that. So Denise, who's in the audience that you're looking to speak to specifically?
Well, we have launched our fund and we are moving towards more on that financier side. So we are looking to partner with best-in-class operators who have systems in place and have a great market share, maybe 8 to 10,000 units or so, and are vertically integrated. Or if they're not vertically integrated, you know, they have those relationships that are just moving like a well-oiled machine. So that's kind of what we're looking at right now. We're vetting a lot of deals. We're underwriting a lot of different opportunities because we're really trying to figure out which deals that we want to invest in and support financially through our fund.
I love it. I love it. So then the people must be thinking, I need to know how to reach out. I'll sandbag that for a second and talk about myself. I've got this really distinct last name, makes me easy to find, especially on LinkedIn, where I spend most of my social media time. Of course, I guess I could throw the Amazon author page I have on there. If you want to search for me on Amazon, I got a few different books on different business skill building related subjects. But if you are thinking of raising capital for yourself privately or otherwise, there are regulations that are involved in it. And if you can pause the video if you want, you can scan the QR codes that are on your screen, and they go to the FAQs page of 506BME, which is the platform that my team helps people out with maintaining your backups and your documentation and your substantive relations. The idea being is if you drop your laptop into the bathtub, the SEC is still going to need to see the documentation of your substantive relations if you're doing 506B deals. And that's going to be a really important thing. But Denise, I know that you're very active on LinkedIn. I think I saw you on Facebook as well, but social media, website, phone, email, what's the best way to reach out?
Like you said, I'm all over LinkedIn, so you can easily find me there, and you could DM me, or you could go to my website, flowequitypartners.com, and you can schedule a call. I'd love to talk to you and chat and get to know how we can add value to each other.
Perfect. I love it. And it brings me to my public service announcement, which is actually not for you, Denise. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button down there that I guess you haven't clicked yet. It's totally free to click the thing. And full disclosure, I want a whole whack of people to click it so that YouTube starts to pay for these videos instead of me. I think that would be amazing. The trade-off to you, just so we're clear, is that my videos may show up on your list of suggestions, which I think is fantastic because you get to see more guests like Denise. But the important thing is you can ignore those suggestions. I just really appreciate the fact that you spent this time with me. Just like Denise, I appreciate you joining me. This has been great.
It was a pleasure. Thank you so much for having me. It was fun.
Awesome. Thanks. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.